The brand new deposit-free mortgage. How does it work? Should you consider it? Keep watching this video. Just a few days ago, Skipton Builders Society launched a 100% LTV mortgage, aka a mortgage where you do not need a deposit. Now, this is not the only deposit-free mortgage on the market. There are actually 15 others. However, what makes this one different is that you do not need a guarantor. The aim of this is to target renters. The logic being, there are many people, especially young people, who can afford high rent, but because of how mortgage applications work, they're not able to be granted a mortgage despite them being able to show that they can actually afford the mortgage repayments. This product is meant to take away that barrier and allow those renters the chance to get on a property ladder for the first time. What are the key things that you need to know about this product? You must be a first-time buyer. You must be 21 and over. The maximum loan that you can get is £600,000 towards your property. This is dependent on how much rent that you're actually currently paying. Since you don't need a guarantor, what you do need is to provide proof of 12 months on-time rental payments and have a good credit score. You must also show proof of having been paying all of your household bills for the last 12 months. The mortgage payments must be equal to or less than 6 months worth of your rental payments that you've been paying so far. What does the interest rate look like? So right now for this product, it is fixed for 5 years and it is fixed at 5.49%. Well, this is slightly higher than other products in the market when you're looking at around 5% on average for 5-year fixed mortgages. Now you've heard how it works. Is this a good or bad thing? Should you consider it? All I can really chime in on this is it depends on your situation. If you're a renter and without the product you would have no other means of owning your own property, then this could be a great option for you. However, it's important to note that because you're not putting down any type of deposit, you have less equity in the property. So what does that mean? Let's say the property that you're borrowing for is worth £200,000. You've taken out a £200,000 loan from Skipton Builders Society and have put down zero deposit. If in 2 years time, the property has now gone down to £195,000, that means you're now in negative equity. The reason being is your loan that you've taken out is still worth £200,000. However, the property is now worth less. So even if you sold that property today to pay off the rest of your mortgage, you would be at a loss. You will have lost 5% equity in that property. Even though there's a risk of it going down, there's also a chance it could go up. But what do you think? Would you be interested in this? And are you going to take a look into this? Follow for more personal finance tips.